and it's very possible, it's highly possible, that the end of this year will be a positive return for the markets. Now, this is always the problem with a lot of this data when you see it. It'll say, okay, when you've had 5 positive months of the year, then the rest of the year is positive, and it's positive by this much, this percentage of the time. Okay, that's talking about full year returns. It doesn't tell you what happens between now and then. This is what you need to know before the bell this morning. Over the last 5 months, the market has yanked out a positive rate of return. So this market's just been climbing steadily for 5 months. And again, this is not uncommon. It happens, but it's a very rare occasion that it happens in the past. And again, as we've talked about before, when markets are this deviated from the 200-day moving average, well, that's where it becomes a bit more problematic. Now, here's the problem with this chart. This is 2018, and this is what happened post-2018. When you had that record deviation from the markets came down and connected back to that 200-day moving average. We've been in this situation before, where we've had very big deviations and very big movements from the markets. Now, this is the interesting thing about this period of time, is that we had a very big deviation from the 200-day moving average. The moving average corrected, tested to it. We then did it again, and just a few months later, going back into 2019, we get another very big deviation, and that deviation then corrected back below the 200-day moving average. Of course, this is 2020 now, this is late 2019. And when we have these big corrections like this happens repeatedly over time. So again, it's easy to take a look at a market that's just trending higher and go, oh, this is great. We're now 5 months positive. And statistically speaking, once you're 5 months positive, that means the rest of the year is positive, and we're going to have a big upside from here. And those are certainly what the statistics bear out. And it's very possible, it's highly possible, that the end of this year will be a positive return for the markets. Now, this is always the problem with a lot of this data when you see it. It'll say, okay, when you've had 5 positive months of the year, then the rest of the year is positive, and it's positive by this much, this percentage of the time. Okay, that's talking about full year returns. It doesn't tell you what happens between now and then. So again, yes, we're positive for 5 months in a row. There's very likely a probability we're going to get a correction. Again, we see this all throughout history. If we just take a long-term look at the markets repeatedly go up and down over time. And again, we retest this 200-day moving average on a repeated basis. You're going to have a reset at some point. It's just a question of when. Now again, a retest of the 200-day moving average, a retest of that is about 10%. So it's not a massive correction that we're talking about. It's no reason to go, hide in the bunker. But you are going to get some type of pullback. It's just a function of how markets work. It happened last year as we were getting ready to go through, we were doing the AI chase into June and July. 5 months positive. Actually, we were 7 months positive at that point. And we said, look, we're going to get a correction. And ultimately, you got that. You're going to get the same thing here again, a retest of that 200-day moving average at some point. It's just a function of when. But for now, it's all risk on. There's absolutely nothing to be concerned about at the moment, because at the moment, everybody is bullish. So everybody's trying to get into the markets. They're chasing asset prices. The fear of a correction is non-existent at this point. Take a look at volatility index as an example. There's virtually no fear of a correction. So again, that kind of excitement, that momentum, that drive behind the market, that psychology is going to continue to push asset prices higher, at least for now. Now, at some point, you're going to get that correction, and again, it'll be a buying opportunity because, again, statistics bear out that when you have 5 months in a row, you typically are going to finish the year out on the positive note. So you don't want to be, out of the markets entirely, but look for that opportunity of that correction at some point, reduce some risk, look for that opportunity of a correction, add risk back to your portfolio. End of the year will likely be positive, particularly post-election, once we get to that part as well. So again, just something to think about as you get ready for the markets this morning, but that's what you need to know before the bell.